This is InvestTalk. Independent thinking, shared success. Justin Klein and Steve Peasley stand ready to take your finance and investment questions and share their unbiased answers. InvestTalk is made possible by KPP Financial, a registered investment advisor firm serving clients throughout the United States. The clarity for your path forward starts now. Here is KPP Chief Executive Officer, Financial Advisor, Justin Klein.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Wednesday, September 7th, 2022 edition. I'm Justin Klein, and I'm excited for this hour with you, answering your finance and investment questions. As always, my phone number is the same, 24 hours a day, 7 days a week. It's 888-99-99-chart, excuse me. I've got a packed podcast for you today, and my focus point today concerns the story behind this headline: stop relying on PE ratios. And this is something the average investor needs to learn quickly. And it's that the PE, and the E especially, is dependent on a single year. But there are other data points to consider when trying to value a stock. And too many people get caught up in the PE ratio and don't understand what is cheap. They think a single digit number is cheap, and they think a number above 30 or 40 is too expensive. And the answer to that question is really, it depends. So we're going to break down the reasons why. So that's our main focus point. I also want to talk about electric vehicle stocks and the companies in the space and how they are going to manage through this period of higher interest rates, higher input costs, and what that means for Tesla, as well as the other recent IPOs that I think a lot of people are getting hyped up about. But I want to unpack the operating environment and the investment environment that they are operating in. So we're going to look at that. Also, we are less than a month away from the end of the third quarter, and I want to do a little review of what analysts are doing with earnings expectations for this quarter, what sectors are doing better and others doing worse, and what the overall growth is likely to be for the quarter. Then lastly, we're going to touch a bit on mortgages in retirement. This is a much debated kind of personal finance thought process that a lot of people go over as they enter retirement. And I'm going to unpack kind of the upside and the downside, especially in a rising interest rate environment. What does that mean for you and your mortgage in retirement? So those are the things that are on my mind, but ultimately I want to know what is on your mind. So I know we have some voice bank questions ready to play as well. So I've got all this planned for this episode of InvestTalk. And of course, I'll take your calls live at 888-99-chart. Now let's take a look at the market today. We had quite the rally. The S&P was up 71 points, nearly 2% on the major indices. You had the dollar reversing pretty nicely, mainly against the euro, as the euro, I think we had the ECB meeting coming up and what their rate expectations are going to be. You also have the entire region trying to deal with higher energy prices, and I know they are pushing through some packages to try to reduce those for consumers, and all that has impacted the euro, at least today. Now the yen, not so much. That was still down pretty nicely, but just shows you that's where the reversal in the dollar came from today, focused on the euro region. But that did give a lift to some commodity prices. Gold, copper was up, but mainly the energy side had actually dipped a bit. So that was a bit of a pullback there. But we definitely have seen I've noticed some major negative sentiment over the past week or so. And that always makes me gets my antennas kind of tingling, right? To just figure out how bearish people really are, and oftentimes that leads to pretty strong rallies. And we're likely to get one, at least in the near term. How far it goes, we shall see. We are in the midst of QT, accelerated QT by the Federal Reserve here this month, as well as the expectation, a 75% chance of a 75 basis point increase at the Fed meeting later this month. And certainly the market has kind of priced all that in at this point. But the question is, how much does that mean to markets? And or the EPS, the earnings per share expected this quarter, which we'll talk about a little later, is a little hint that a big breakdown in markets is relatively unlikely, despite the headwinds on the monetary side. So kind of a choppy period, still kind of neutral to slightly bearish overall on the indices. But near term, this move today, you had the VIX with a bearish engulfing, which means that's positive for the markets, and the S&P a bullish engulfing, and then the NYSE that also had a nice move today as well, over almost up 1.5%. So oversold conditions into support. Not surprised to see a rebound. And I think the big tell will be how much of a reversal can the dollar get. If it's a big reversal, then I think the markets can get a nice reversal. If it's only short-lived, short little pullback, then that's going to mean more pressure, continued pressure on the markets downward. So that's the market today, and we'll have big CPI data next week on Tuesday. That will be probably the biggest economic number to come out between now and the next Fed meeting. Now let's get to our first listener question now.
Hi, Justin and Steve. This is Jade from Utah. I have a question about Porsche and its upcoming IPO. Ticker symbol is POAHY. I bought it and it's down. As you can imagine, it hasn't done so well these last 6 months. And wondered what I should know about the IPO, if it's something that you think it's worth holding on to. I know that Justin has mentioned it in the past as a better play on electric vehicles, perhaps because of its connection with Volkswagen. And I wondered if there's anything I should know about the IPO, if it's something that I should either get rid of before the IPO or if I should hold on to it until after the IPO. Thanks for your help.
All right, now looking at Porsche, and I have said in the past that if I'm betting on one car company and for the EV transition, it's going to be Volkswagen and specifically Porsche. The Porsche stock has a controlling interest in Volkswagen, and it's frankly undervalued compared to the Volkswagen listing. So that's why I've said that's been kind of the number one. Now, frankly, any of the electric vehicle makers are difficult businesses longer term. I've said that many, many times. So Volkswagen is no different, just they're the best prepared out of all of them because of their history, because of their brand, many brands, as well as their expertise at building vehicles at scale, which is, remember, the auto industry, that's what it's about. It's about efficiency and quality and scale, because you need to produce a lot of vehicles to make the R&D or the CapEx spending to build plants, maintain plants, etc. Spread that out over a large number of vehicles, and that's the way it makes sense. That's what the car business has always been. That's why, in the 70s and 80s, the Toyota and Honda, they started to eat Americans' lunch because they were better at efficiency and scale. And that's just the history of the automobile industry. And so I don't see electric vehicles being any different. So if you hold Porsche, I think the IPO is probably a good thing. It's going to open up easier ways to buy the shares on if it's U.S. listed. Right now, it's obviously listed on foreign markets. And so I would probably hold through it to get that burst. Now, would you hold it long term? Well, that depends on how much you really want to hold an EV maker. I'm always a bigger fan of the companies that produce the things that go into the cars that are necessary. because their businesses tend to be more consistent. Their pricing power tends to be more consistent, as opposed to the actual vehicle production is always pretty cyclical. So I would hold it for now, but it maybe would be on the lower list of the type of names that I would hold longer term, unless you were adamant about holding an actual EV producer. Now we're heading into a break. Steve Peasley and I are happy to play your recorded voice bank questions, but we love taking your live calls as well. It's a chance to interact with our listeners, and we love that. So give us a call on InvestTalk at 888-99-CHART.
Why do listener questions make InvestTalk better?
Which of these would you recommend?
Because each caller presents fresh questions in their voice.
I was curious if you still think aluminum has a ways to go from here.
When do I know the right time to take profits?
Should I be looking for an exit? Should I be holding here?
And listeners instinctively realize that InvestTalk uniquely offers a welcome dose of investing satisfaction.
I think you have a terrific show, and I've learned a whole lot.
Hey guys, love your show. I've been listening for several years now, and I've learned a lot.
Justin Klein and Steve Peasley understand what investors need and want.
I would look at it from a tax perspective. If there's no tax implications, move on, find better ways to use that money.
I'm going with the odds. I think a half position now would at least get you in it and get you watching it so you won't lose track of it.
Don't forget to call InvestTalk, 888-99-CHART. Each day, InvestTalk listeners submit their finance and investment questions via phone or email. Would you like your question to be put near the top of the list? Just take a minute or two to leave a review and rating for InvestTalk at iTunes. And be sure to include a brief question with your iTunes review comments.
Now, when people take the time to leave an InvestTalk podcast review on iTunes, we like to thank them for their courtesy, but getting to their questions quickly. Outlier 1 says, I purchased PFIX interest rate hedge as a speculative position at $40. It is currently near all-time high at $58.95. I'm considering selling all or half of all my position at these highs. What is your opinion on PFIX? Should I take my gains now or hold? All right, this is an interesting one. This is the Simplify Interest Rate Hedge ETF. And I don't know a lot about it, but it looks like is when interest rates rise, this rises. So it does have an expense ratio about 50 basis points. So it's kind of expensive, but not really for a speculative vehicle. I say it like this because I don't think speculative and investment kind of go hand in hand. It's a speculative vehicle. And today it's pulled back as interest rates pulled back to down $2.34 to 60 and change. And the answer to your question is, I do think that this is a good time to sell this position. Why? Because the 10 years moved from a low of about 2.5 back in early August, and now we're at 3.25, even after being down 77.5 basis points today. And I think we're in a range-bound situation for interest rates. You know, we've been bouncing around really since April. Remember, the Fed started to aggressively tighten or give rhetoric towards aggressively tightening, meaning more than just 25 basis points per meeting, talking about 75 basis points, which if they did it for September, that would be the third consecutive 75 basis point hike. Remember, they started talking about that in the April-May timeframe, and that's really when the 10-year started to peak out, right around 3%. And we've been gyrating above it and below it by, say, 50 basis points pretty much ever since. And so we're at the top end of that range. And so from a speculative standpoint, you kind of got most of what you're going to get, at least in the near term. And I think we're in a range-bound situation until there's some resolution to where inflation is headed. I talked a little bit today on office hours about how there's a strong correlation between the ISM services paid index and the CPI number. And it's usually 2 months lagged, meaning when the PMI services index starts to move, in earnest, either up or down, usually you start to see that number on the CPI reflect a couple months later. So there's a little bit of a lag there. Now, we've seen a big drop over the past couple of months in that prices paid index, and that means inflation's likely to head a bit lower as well. And so this is something that means that until there's a resolution of where the interest rates are going to go, where inflation is going to go, then interest rates are likely to be range bound. So that's why I would take your profits now and move on. Now we're heading into a break, and I welcome your finance and investment questions. So give me a call at 888-99-CHART.
This is InvestTalk. Is your portfolio balanced? Is it optimized? Is it delivering the types of gains you want and need to achieve financial freedom? Well, turn up the volume, because there are many questions that deserve unbiased answers. And Justin Klein is here now, ready to take your calls live. 888-99-CHART.
Now, my focus point today concerns the story behind this statement: stop relying on PE ratios. And I hammer this home a lot, but I want to dig into the details. And if you've been listening to the show for any length of time, you will know that I think valuations matter in the long term. Short term, that's often not the case. Usually earnings revisions, interest rate movements in the economy, etc. But in the long term, valuations are important. The problem is that the vast majority of people rely on PE ratios as their measure for valuations and intrinsic value of a company. And the reality is there are a lot of caveats to that PE ratio that most investors don't understand and they don't account for. So let's start with the P. The one caveat is fairly simple. When you're looking at the P part is the price, or in the actual calculation, it's the market cap of the company. But the market cap doesn't include net debt that the company has in the balance sheet. So that's enterprise value. And that's why I rather use enterprise value, okay, as the top of that ratio. The bottom is E, and the E can mean a lot of things, right? Earnings per share or net income. And there are two types of E. One is forward, one is trailing. Trailing ratio looks at the last 12 months and says, okay, what did they earn? And then forward is what are analysts expecting the next 12 months earnings to be? So both are very different. It depends on what you're looking at and what you want. And then that also only looks at 1 year. And the value of any company should not be summed up in the earnings of one single year. Okay? And the reason for that is because some companies are consistent and others not so much. Now, the first thing is one-time charges. So these are non-cash, usually charges to earnings, and they can be for a lot of different reasons. One of the biggest reasons would be for writing down the value of a particular asset. Okay? Meaning they had, this happens a lot with the banks, where they lend money and they have to set aside money for reserves, for defaults. And these are non-cash items, but these are basically expectations of defaults in the future. Whether those are actually accurate or not is another story, but they will do that from quarter to quarter. They will change that write-off that they're hitting to earnings. Others could be a write-down of a particular asset that they own, a building that was impaired, or a brand that they had put a large value on because the brand was doing very, very well, and then suddenly a competitor comes along and their brand is now better, and now this company has to write down the value of that brand that they thought was higher. It's a non-cash item, but they have to adjust for those things, and that can mean short term that the E can change dramatically based on those one-time charges. Okay. Now, next is durability. And the consistency and durability of the business basically means that there's a competitive advantage. And Warren Buffett always looks for this, a durable competitive advantage. And because he wants to see what the business will look like 10, 20, 30 years from now. That's why he loves Coke, because Coke is a brand that's been around for many decades, and their brand is very well known, and their business is very consistent. And so he's willing to pay a premium for a durable, consistent business that he has very strong confidence that there will be around a decade or two from now. And I absolutely agree with that. Paying higher than average multiples for those durable businesses is absolutely real. It makes sense. There are very cyclical businesses. Commodities are a very common one. Most commodity companies trade at low multiples. Why is that? Well, it's because there are good times and there are not so good times. And in the not so good times, they tend to lose money because their products are in oversupply. They're producing them at a negative margin. And what do they have to do in those times? Well, they have to increase their debt load. They have to issue more shares. They sometimes have to cut their dividend. Whereas a more durable business, they're the opposite. They're buying back shares. They're increasing their dividend, and they're reducing their debt. Okay. And then there's growth. And growth is remember, this is growth of earnings, not revenue. A lot of people talk about revenue, talk about growth stocks. Business growth is very important. And YCharts has EPS growth rates on average about 9%. So if companies are growing well in excess of that consistently, then you're willing and should be willing to pay an extra premium to that. Okay, so that's important. And then cash and cash flow. So cash flow can be nicely positive, but earnings per share can be very, very negative or muted. And so you want to account for that when you're doing these valuations. We're heading to a break. This is InvestTalk, so give me a call at 888-99-CHART. If you don't know the numbers, you don't know your business. That's true when your business is growing fast, and even more true when there's a lot of uncertainty. Inflation is running rampant, supply chains are clogged, and labor market is tight. What does that mean for margins? But not every business is in the dark, and NetSuite is helping business owners everywhere. Over 31,000 businesses know their numbers because they use NetSuite by Oracle, the #1 cloud financial system. NetSuite gives you visibility and control of your financials, planning, budgeting, and of course, inventory. So you can manage risk, get reliable forecasts, and improve margins. Everything you need, all in one place. In 2022, profit is the new growth. So NetSuite helps you identify rising costs, automate your manual business processes, and see where to save money. Know your numbers, know your business, and get to know how NetSuite can be the source of truth for your entire company. Right now, NetSuite is offering a one-of-a-kind flexible financing program. Head to netsuite.com/investtalk right now. netsuite.com/investtalk. netsuite.com/investtalk. Take a guess. How many job seekers do you think visit LinkedIn every week? The answer is 40 million. As anyone who has ever had to search for excellent job candidates can tell you, finding the right job seeker can be a daunting task. That's why you will appreciate the power of LinkedIn. Create a free job post in minutes on LinkedIn Jobs to reach your network and beyond, to the world's largest professional network of over 810 million people. Then, add your job and the purple #hiring frame to your LinkedIn profile to spread the word that you're hiring so your network can help you find the right people to hire. Simple tools like screening questions make it easy to focus on candidates with just the right skills and experience so you can quickly prioritize who you'd like to interview and hire. It's why small businesses rate LinkedIn Jobs #1 in delivering quality hires versus leading competitors. LinkedIn Jobs helps you find the candidates you want to talk to faster. Did you know every week nearly 40 million job seekers visit LinkedIn? Post your job for free at linkedin.com/invest. That's linkedin.com/invest to post your job for free. Terms and conditions apply.
You are listening to InvestTalk. Every Friday on the program and the podcast, Steve Peasley shares highlights from the newest edition of the KPP Premium Newsletter. Listen Fridays to InvestTalk. And now, Steve and Justin welcome your calls and questions. 888-99-CHART.
Eric from Virginia, hang on. You'll be next. But tomorrow on InvestTalk, the story behind this question: should bonds still play a role in your portfolio? And now I want to finish what I was my focus point, which was talking about PE ratios. And I really want to get to cash and cash flow. And Amazon is a good example of a type of company that didn't report positive net income for many, many years, but was cash flow positive for a long period of time. And the reason is because they were investing in a lot of physical properties and fixed investment that tends to be depreciated, even though it is really not depreciating in a lot of ways, especially real estate. But remember, the E is backing out depreciation, it's backing out amortization, which are non-cash items. They're just basically accounting metrics that vary depending on the type of asset and the strategy the company has with that particular asset. And so oftentimes E can be misleading, especially when you're in a big investment cycle and writing off a lot of that money that's going into the business. So make sure you're aware of that. And then E also doesn't consider current cash sitting on the balance sheet. So if a company is just raking in the cash and they're just putting it on their balance sheet, maybe investing it in cheap, secure, safe securities. Think of Apple. Apple's been doing that for a long period of time because they produce so much cash. That E is not accounting for that either. And so it's important to delineate when you're looking at the E and PE ratios and, why could it be high or why could it be low? Depending on the durability of the business, the growth of the earnings, the cash flow, the current balance sheet, etc. If the durability is high, you're going to be okay paying a premium. If the durability is low, probably not so much. Same with the growth of earnings. Same with cash flows. All of these things are very important when you're trying to understand the intrinsic value of a business. So don't get caught up in the PE too much, because it is a very, very flawed metric. Now let's go to Eric in Virginia and wants to talk about gold and silver prices.
Hey, how's it going, Justin?
It's going well.
So I'm calling because it seems like over the last year or so, the biggest headwind to gold and silver has been the rising dollar. Mm-hmm. And, kind of my thought process would be that, at some point that's going to turn around. Mm-hmm. But on the flip side of that, I'm also wondering if just the fact that, deglobalization is definitely playing into America's favor, in my opinion, with just the fact that we're set up better to be, independent from a lot of other nations versus, other nations aren't. Is that something that could potentially make the strong dollar last longer than maybe I thought it would?
Yeah, absolutely. The fact that we are more stable as an economy, we're a more diversified economy. We don't have to import a lot of raw materials, whether that's energy or soft commodities, or other types of hard commodities. I think that's certainly true long term. We're set up fairly well, energy independent. We're the largest energy producer in the world, as well as we have a lot of deposits of, copper and uranium and all types of other minerals that are important, as well as ag. We're the largest agricultural exporter in the world, and so I think you are correct in that sense, especially if you compare it to the likes of Japan or China, who have terrible demographics, which we have pretty good demographics. So all of these things are setting up for America to be stronger on the other side of this, but that doesn't mean that it's going to be consistently strong. The dollar, the dollar is going to go through its up and down cycles. Right now, we are tightening policy much faster than the rest of the world. The rest of the world's trying to catch up with us. And then on top of that, we stimulated our economy to a large degree. And so that is all wearing off. And it means that our economy is moving back towards what the rest of the world's been doing, which is since the pandemic, which has been in more of a fits and starts type of process, where we had huge growth because in late 2020 and 2021 because of tons of fiscal and monetary stimulus, and so that's going to wear off in relation to the rest of the world by sometime middle part of next year. And I think that's something to consider in the medium term. And then the fact that inflation is likely to peak here in the back half of the year and come down pretty decently, especially in the first half of next year. So all of those things makes me think that the dollar is likely to be at a near term, intermediate term top, at least close to it. When we actually see that, we'll see. Maybe today was that first big reversal. But I do think that gold and silver are at a longer term bottom, especially if you zoom out and you look at the support levels, you look at the pattern. This is major support, and it's held it despite a strong dollar, despite higher interest rates. All those things should be should say that the gold and silver are gonna break down dramatically. And they're certainly down, but they're not falling off a cliff like you would expect them to do with those other headwinds. And so that relative strength is telling me that the longer term bullish setup that is within the precious metal space remains intact. And so long term, the dollar can go up and gold can go up, but obviously near term, that makes it a little bit more difficult. Thanks for the call. 888-99 chart 888-992-4278. Let's talk about electric vehicles. And we had a pretty big sell-off last week in electric vehicle stocks, and Rivian finished down 21% after Ford Motors announced that they're going to sell, or they had sold, a large stake that they owned in it. And it's now down 71% from its IPO price. And other large EV makers like Lucid, they had first quarter earnings, and they expect production between 12 and 14,000 vehicles in 2022. And that's after reducing in February from 20,000. So they stuck with that lower target, and they're dealing with a lot of headwinds to their business and rising costs. And it's not just about those rising costs, but it's also related to rising interest rates. And, it's a lot of the value that the market has put on these EV makers is based on long-term growth potential. And that long-term growth target is easier to hit when capital is essentially free. But the rising cost of capital now is hitting these speculative stocks as well as all other speculative stocks like we talked about. And launching a new car maker is very expensive. And the costs are for many years before there are any profits. So bridging that gap is much easier when interest rates are very low and the cost of capital is essentially free. And companies like Rivian and Lucid, they came to market when capital was a lot cheaper. And they still have a lot of cash on hand. Luckily, Rivian has about $18 billion at the end of last year following its IPO. Lucid has $5.4 billion at the end of March, although they burned through $680 million in just the first quarter. And it said last week that it had money to fund itself well into next year. But that basically implies, guess what? They're going to have to go back to the market next year, which is not far off. And so the cost inflation this year has pushed out expectations of when these EV companies will be profitable and how affordable they will be to consumers. You know, we've talked about this inflationary environment and the push towards electrifying our grid and modernizing our grid, electrifying our vehicle fleets, etc. All this is going to take a vastly more reliable infrastructure than our current manufacturing process of internal combustion engines, as well as delivering gasoline. All of that has been done for decades. And most of it is steel and aluminum. You know, there's not a whole lot of complexity to the types of inputs that go into an internal combustion engine car. And those supply chains are well tested, well supplied, and reliable. Whereas the supply chains for the EV side are much more complex. You're talking about lithium, you're talking about nickel, you're talking about cobalt, you're talking about so many other minerals, copper, that are needed, and some in vastly larger quantities. And so that's going to push the cost curve continually upward and make it even more and more difficult for consumers to ramp up their buying because those costs are probably going to continue to spiral higher as opposed to lower. And that makes it even harder for the EV companies to make money. So despite the hype and the hope of a long growth trajectory, the odds are very low that these companies are going to get to profitability anytime soon, and their cost of capital is likely to head higher. Now we're headed almost into summer's end, and it's still hot in many places. I know it's very hot here in Laguna Beach, and it's the time of year when market volatility is also higher, and it means you need to pay attention and stay updated on the current macroeconomic trends as well as the microeconomic trends from a company and sector perspective. So I think it's worth taking a minute to make you aware of some of the benefits of working with myself or Steve Peasley at our company KAPP Financial. We're based in Irvine, California, and you can reach out to us and schedule a complimentary portfolio review assessment via telephone or go-to meeting. And we can talk about whatever is on your mind, go over your portfolio, your risk, and your ultimate goals to see if they are in line. And at KPP, it's where we provide unbiased guidance both on and off air. And we practice parallel investing, which means we invest right alongside our clients. So no obligation, your call, we can talk. And the sooner you connect with us, the sooner we can help you get your portfolio optimized. Next up, we will play another listener question from our toll-free InvestTalk voice bank at 888-99-CHART.
Why do listener questions make InvestTalk better?
Which of these would you recommend?
Because each caller presents fresh questions in their voice.
When do I know the right time to take profits?
And listeners instinctively realize that InvestTalk uniquely offers a welcome dose of investing satisfaction.
I think you have a terrific show, and I've learned a whole lot.
So don't forget to call InvestTalk. 888-99-CHART.
Hey, Steve and Justin, love the show. I hope you can answer my question. I'm a small-time real estate investor. I have a few long-term rentals, and so I understand how that works, and I love 30-year fixed-rate loans. My question is regarding REITs that have commercial property. I know that the amortization's a little different. They have to refinance every 5 years or so. The interest rate changes. Particularly, I've been buying STAG, STAG lately. They own warehouse buildings. And I'm wondering what you think, how the interest rates going up is going to affect commercial real estate, and what you think about STAG, STAG. Thanks a lot. Love the show. Looking forward to the answer.
All right. I love this call because he's highlighting STAG Industries, and this is a REIT, a real estate investment trust, that acquires and operates single-tenant industrial properties throughout the United States. And the vast majority of the portfolio are warehouses and distribution buildings. And they did very, very well. Their earnings, or funds from operation, which is how you quote earnings in the REIT side, that had a big boost in 2021 from $1.83 in 2019 all the way to $2.05 in 2021, and that's much better growth than they typically used to. But that has come back a bit to $1.93 expected this year, and then a $2.03 next year. So a bit of a bounce back, but not a high growth business. But their revenue is certainly going up, but their input costs are going up as well. So, but overall, I like the business. And you talked about commercial properties, and that's certainly true. The financing costs are different than your typical 30-year fixed rate mortgage. But good REIT companies, with their diversity of their businesses and the number of properties, they typically have pretty solid lenders and pretty low cost of capital, although it will go up a bit. So I don't see this being an issue for this type of company because of the strength of the warehouse and distribution business. Even though it's pulled back a bit, it's still long-term, I think secularly, they're in the right place. I wouldn't want to get into office REITs, for example. I think that's going to have continuous pain over the long term. And so that's a different kind of side of the commercial real estate space. But STAG, to me, is on the right side. So I think it's a good one. It's already pulled back pretty dramatically, really back to pre-pandemic levels. And their funds from operation expect to be a bit higher than those. So I like this. The chart is kind of firming up. So I'm going to give STAG a thumbs up. And I like that you're looking to diversify your real estate holdings just a bit. Thanks for the call. Now, this is InvestTalk. I'm Justin Klein, and we have one goal here each and every weekday, and that's to help you achieve your own version of financial freedom. And our work continues after this final break. So if you're going to call, you want to do that right now at 888-99-CHART.
This is InvestTalk. For serious investors, it's all about achieving financial freedom. That's why the unbiased guidance offered by Steve and Justin is so valuable. The InvestTalk Anytime listener lines are open now, and Steve and Justin welcome your questions. Call 888-99-CHART.
Hello. I was wondering what your current thoughts are on Apple, AAPL. I'm currently a shareholder, and I've actually had some pretty nice gains on it and would not hesitate to add to that position with the anticipation of future growth of the company and the stock as well. As I leave this voice message, it is about 156.23. That's on Friday afternoon, September 2nd. Look forward to hearing your answer, and thanks again for what you guys do.
All right, looking at Apple, AAPL, and they did just have their iPhone / AirPod Pro 2 / what else did they announce? They announced something else today. But mainly it was their iPhone event, and clearly that's a big driver for their business. And I do think that upgrade cycle is going to mean good growth in sales for the back half of this year and next year. Now our fair value, we deal in this for clients. Our fair value is about 150. Now it's at 154 and change to close today. So, I think it's about fair value. I don't think it's necessarily cheap. I don't necessarily think it's expensive. It's certainly a durable, consistent business with good cash flow, like we talked about earlier. So certainly willing to pay a premium to a forward-looking P ratio somewhere in the mid-20s. And I think that's where it should be, where it should be priced. So I don't think, once again, it's expensive or cheap. It's about fair value. Thanks for the call. Now let's touch a bit on earnings estimates, and analysts, per usual, they tend to adjust their earnings as the quarter goes on, and their expectations for the third quarter have fallen about 5.5% since the start of July. dropping for every sector except for energy. And what sector has seen the biggest shift in analyst earnings expectations? Well, that would be technology, down about 30%. And then when you have, first half of the year, energy was the only segment to rise during the first half of the year when it comes to earnings expectations, and up 61% year to date. So that's where you're seeing by far the most growth. Financials, non-cyclical, so think of consumer staples, materials and industrials, and discretionary. Those are all the sectors that had the biggest earnings revision downward for the third quarter since July, so a little over a month. And you only have a few more weeks left in the quarter. But overall, earnings growth for the third quarter is expected to be 4.7%. Now, if there were similar surprises to the third quarter as there was for the second quarter, well, then the actual growth would come in at 9.6%. Remember, this is nominal. This is not taking into account for inflation. So in real terms, earnings are down. But remember, the market, the price you're seeing on your screen, is not adjusted for inflation. It's based on earnings per share. And earnings per share itself continues to go up. And that's why I always say, in an inflationary environment, most stocks tend to go up. It's actually a pretty decent inflation hedge as long as inflation isn't out of control, which it's starting to become more in control. So I wanted to highlight that and give you an update of where we are when it comes to the earnings trajectory for this quarter. Still expected to be about a 5% growth for Q3. Well, I think that does it for another episode of InvestTalk. I am Justin Klein. Steve Peasley and I thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, and it's official. We will cross over the 50 million mark tonight, thanks to you. And you can get your InvestTalk podcast downloads anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes. And if you leave a brief question with your review, we will prioritize your answer. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights. For more information regarding KPP's investment advisors, call 1-800-557-5461. Steve Peasley is president, and Justin Klein is chief executive officer of Klein, Pavlis, and Peasley Financial. Thank you for listening, and your comments and questions are welcome on our 24-hour listener line at 888-99-CHART.